Een goedemiddag allemaal, fijn dat jullie er zijn. En eerst keek iedereen natuurlijk naar een blanco podium en een blanco scherm. En dat is nou precies wat we duidelijk willen maken. Wij zijn Cyber Capital en wij investeren in digital assets, cryptocurrencies. Hoe we dat doen en waar we zo direct onze beleggingsstrategieën, hoe we die bepalen, dat hoort u zo direct. Het belangrijkste is ook de structuur. En daarom liet ik u even naar een leeg podium kijken. Want wat is een leeg podium? Alleen maar onzekerheid. Daarom gaat over secure investing, gaat ook over de structuur van je organisatie. En als Cyber Capital zijn wij het langst bestaande beleggingsfonds, een van de langst bestaande zelfs in de wereld, en een van de zeer weinige met een officiële registratie bij de AFM. Dat betekent dat we onze structuur zodanig hebben als eigenlijk een traditioneel beleggingsfonds. Met een externe administrateur, een externe controllers, een externe stichting, zodat uw geld, het geld van onze beleggers, altijd veilig is. Er kan geen enkele fondsmanager, tussen aanhalingstekens, met onze assets er vandoor. Dat hebben we ook doorgevoerd in de structuur van hoe wij beleggen. Elk handelsplatform is door ons gescreend en is door een governance controle gegaan. Degenen die de cryptomarkt volgen de afgelopen 2 jaar weten wat het betekent als je dat niet doet. En datzelfde geldt ook op de wijze waarop we onze rekeningen aanhouden. Bij heel veel platforms kon je alleen maar een particuliere rekening openen. Dat betekent dat een zogenaamde fondsmanager op zijn eigen titel zat te handelen. Met uw geld. We hebben de afgelopen maanden met ieder platform waar wij zaken willen doen, hebben we ze aangedrongen en geforceerd om een corporate account te kunnen openen. Een corporate account waar dus niet 1 iemand in zijn eentje bij kan om alles naar de Bahama's over te boeken of in Thailand te verdwijnen. Maar eentje waar alleen maar in een combinatie van 3 partijen gehandeld kan worden. Extern, IQ-EQ, sommigen van jullie bekend, die doet voor heel veel beleggingsfondsen externe administratie, een stichting derde gelden en wij als beheerder. Tot zover de structuur, daar ga ik over. Ik ben Gert Jochems, CFO van Cyber Capital. Maar u komt hier vooral ook om te luisteren hoe wij beleggen. En hoe wij beleggen, daar gaat Justin zo direct alles over vertellen. Maar omdat dit nu eenmaal een 24/7 wereld is, volstaat die Nederlandse taal niet. Dat kunt u begrijpen, want overal in de wereld moeten we tegelijkertijd kunnen zijn. Dus Justin zal ook zijn verhaal in het Engels houden, daarmee ook aangevend dat wij de wereld ook kunnen controleren. Mag ik uw aandacht voor Justin, onze Chief Investment Officer van Cyber Capital.
Thank you. All right, I'm Justin Bonds from Cyber Capital, and we do long-term investment based on the fundamentals. This is distinct from, say, day trading. It includes a lot of understanding. So the idea is that by gaining a better understanding of cryptocurrency, we know how to invest and where the value lies. This is a lot of what I do. I focus on the fundamental analysis here. Now we have multiple partners, as you can see, and this is what Gert was referring to as well as being a legitimate party in the Netherlands. One of the few that is able to apply these high standards and due diligence. Now to the fun stuff. So I would like to maybe start this off with explaining cryptocurrency a little bit for you guys. So who knows what this is? Put up your hand. All right, great. That's actually, things are improving over the years, and that's something I've noticed as well. The general knowledge seems to be improving, which gives me more hope for a rational market over time as well. So this is a blockchain. This is what it's all about in many ways. It's a chain of blocks. It's in the word, right? Now, what's interesting about this is obviously it creates a ledger that's distributed, which therefore cannot be corrupted. Now, that's a very valuable thing. A single source of truth, which is neutral and frictionless. Where immutability is also created. Does anyone not know what immutability means? Please raise your hands. All right. So immutability means that it cannot be changed. That you cannot go back in history and change the ledger. You cannot change the past. So with a blockchain, history is no longer written by the victors. History is for all to record. And for us in later generations to interpret, of course. Now, I'm not going to get too stuck into the technicals here. I think it would be more interesting talking about, why cryptocurrency and how our investment strategy works. So I'll start with investment strategy, which I think is something that many of you are interested in. So when we look at a cryptocurrency, we're able to ask certain questions in common. And these are some of the first questions we ask. The first question we ask is, what is the consensus algorithm of this cryptocurrency? And that's really just a fancy word for this, the blockchain. So the consensus algorithm of Bitcoin is, let's say, proof of work. And there are other types of consensus algorithms, different ways to do blockchain technology. And it's not particularly clear to most people what are the best ways to create a blockchain. And this creates a lot of uncertainty in the market and a lot of unknowns. And this is something that we specialize in understanding what has merit. And for us, what has the most merit is actually utility. So what we want to see when we invest in cryptocurrency is we want to see tangible economic benefits. We do not invest in hot air, which is something that a lot of people might associate with cryptocurrency. But the reality couldn't be further away from the truth, is that the utility and the benefits that this technology represents are profound in terms of changing our civilizations, changing our power structures, changing how we do finance, changing how we do governance. It is very far-reaching. And this is difficult for people to grasp. And that's okay. It's like understanding the potential and the profound nature of the internet in 1993. Most people might not have seen the potential there, but some do. And I like to say that confidence in cryptocurrency comes from understanding, not trust. Because if you understand cryptocurrency, then you also understand that you do not need to trust cryptocurrency. And that confidence comes from understanding these trustless mechanisms. And this is, these concepts might seem profound, might seem abstract, but at the same time, they're very far-reaching in terms of the opportunities, new business cases, new use cases that this creates. And this is something that we're very excited about. So, to go back to the investment strategy here. So the first thing we look at is the consensus algorithm, which is the fundamental design of a blockchain. How is it put together technologically? How are the incentives constructed? What are the outcomes of different forms of governance? This is important. A use case is important. We are not going to invest in purely speculative assets. We look at what is useful. What can actually benefit people in their lives? What can save businesses money? If a technology can approach a business and say, we can bring down your costs by 50%, and it's more secure, and it's easier to use, that is something that I find compelling. And that is something that our investment strategy is very focused on, is actually recognizing the potential of this technology and what it can do in our world. And as an investment fund, we're able to create a product that gives everyday people exposure to this potential. Because it's a very difficult thing to understand. I've been researching cryptocurrency full-time for 6 years now, and we have a team of people that research cryptocurrency from different disciplines as well, which is important to keep in mind, that cryptocurrency is a multidisciplinary field. You need to understand things from some computer science to game theory to politics and economics. It's very far-reaching, but this is the service that we're able to provide through our expertise, and thereby provide our customers with the best possible exposure to the best possible cryptocurrencies for people that do believe in this technology. Now, for a cryptocurrency to have a good use case is not enough for it to be a good investment. So, for a cryptocurrency to be a good investment, what we need to see is what we call good token economics. And what I mean by that specifically is that if a token is being used, that there are mechanisms within its design that then create demand for that token, which brings value to that token and which creates a better form of investment for us. We would not invest in a cryptocurrency without a clear value proposition. Now, what we've been able to do is we've been able to divide cryptocurrency up into 3 layers in order to better evaluate a cryptocurrency. And these 3 layers require a different form of analysis and a different type of way of understanding them. So the 3 layers are this. We have the protocol layer, which is also known as a base layer. That's the blockchain. That's where the security comes from. And these type of cryptocurrencies are commodity currencies. They're a currency, they're a store of value, and they're also a platform for trust without centralized authority. Right? That's where a lot of the application lies in terms of new use cases, and also obsoleting already present use cases in this case. So we also look at the governance and politics of systems, because these are still very human systems. I think a lot of people often make the mistake to look at a cryptocurrency and think that it's purely just a piece of technology, that it's just an automaton that's running, that does not require any human politics or does not require human beings at all. Now, that couldn't be further away from the truth. I see cryptocurrency more as, let's say, a cyborg, where it's part human, part machine. What we're in fact doing is we're incentivizing behavior through people's own self-interest to bring about outcomes that favor the public good. Now, a cryptocurrency should be seen as a public good. And the people that run cryptocurrencies, from stakeholders to miners to all different scale of parties you can imagine, their incentives are aligned, let's say through their own greed, to do what's in the best interest for themselves, which is therefore also in the best interest of the system. And that's because they have skin in the game. Now, this is what I call a proof of positive incentive, and this gets me back to this chart again, in that to create a block, either through proof of work or proof of stake, it costs an immense amount of money to actually create a block in the system. And that immense amount of money that's required acts as a barrier for people to attempt to corrupt the system, because you can't go back in time. These blocks are cryptographically linked with each other. So in order for you to rewind the chain, so to speak, you would have to pay the money for all of the blocks preceding it to the point where the history would split, or to the point where you would want to corrupt that ledger. And so far, the system has proven to work. Undoubtedly. It's a very powerful technology, and that's something that we are very excited about. Now, to go back to the 3-layer model here, Ethereum as a base layer there's very strong network effects around security, so that's why base layers are important. Now, in terms of analyzing a network layer, we apply a different type of metric. So for a protocol layer, okay, it can be understood as a currency, it can be understood as a store of value, and it can be understood as a platform. And these are value propositions, though they are more tentative. Now, the great thing about network layers is we're able to apply more, let's say, traditional metrics to this. Now, if I were to use an example, something like MakerDAO, MakerDAO actually has a governance token and a utility token. And as investors of MakerDAO, right, we get a say over the governance of that system, and we get dividend payments based on the usage of that system. And this is a fully decentralized cryptocurrency, and what you're starting to see here is that it has a lot of similarities with what you'd see as a stock, you know, a traditional stock, where you can actually see the use, and you can also see the dividends coming within the system, which is also built on this blockchain technology with no central points of failure or control, which provides a very high degree of security, unprecedented really in our history. It's also important to mention that on top of the network layers, we also have the application layer. And what we see, you see the arrow down the side there? That shows how fees travel through the system. So let's say I have an application, let's say it's an exchange, DYDX, which is an exchange. And let's say I leverage something like MakerDAO for utility token and the Civic, say, for identity, in this example, then these fees end up traveling all the way down this stack because they still operate on the Ethereum blockchain in this example, which means that the Ethereum blockchain directly benefits from anything that's built on top of it. And this is true for any base layer, be it Bitcoin, be it Dash, be it Tezos, whatever you might think. So this is important to understand. So what we're seeing here is we're seeing ways of understanding cryptocurrency that show how value travels through the system and also shows how we can invest in this objectively with knowledge. All right, so I'm going to get into why cryptocurrency. Why should we care about this at all? I mean, it's this strange internet money that people are talking about. Well, it's rather significant, and I mentioned this before, is that cryptocurrency allows us to have trust without centralized authorities. And this can be extended to many applications, currency just being one of the first applications of this technology. It can be seen as a social technology. It can definitely be seen as a social experiment, in the same sense that the United States of America is also a still running social experiment. And this is how these systems have to be tested. We can't test these systems in lab conditions because they require scale and they require large social coordination in order to actually see effectively how the governance of these systems plays out. Now, as I mentioned before, cryptocurrency removes middlemen, and this creates efficiencies within an economy. Cryptocurrency also represent new forms of governance, which were simply not possible before. I have a background in political philosophy myself, so that was one of the things that really drew me into cryptocurrency initially, you could say. Compliance and regulation in a cryptocurrency is actually built in, if you think about it. The network considers a transaction valid or invalid. And if you compare that today, where billions are being spent on anti-fraud, this system creates huge efficiencies. We were able to remove middlemen, and we're able to improve the wealth of our societies. All right, so cryptocurrency represents an evolution of governance. And the reason why I say that, if we look at the past few hundred years of political history, is we see a pattern of a greater division of powers, a greater distribution of power. This cryptocurrency, in many ways, represents a natural extension of that. And that decentralization is actually a evolution of the concept of the separation of powers. What we're doing with a cryptocurrency is we're spreading that distribution of power wider so that no single party can have control over the system. In many ways, a cryptocurrency is a lot like the precious metal coins of the past. This is what makes it a monetary revolution, because it represents a return to commodity currency. An asset that is both a commodity and a currency, just like the precious metal coins of the past. Furthermore, cryptocurrency also is a form, you must all be familiar with the separation of church and state. This is an old political concept. I'm sure you're all familiar. Please raise your hands. You're all familiar with this. Great. We're in an enlightened room here today. So when we have the separation of church and state within Western societies, right? Cryptocurrency represents the separation of the monetary power from the state. You know, the significance of this is hard to understate. It is, in effect, sound money for the people and by the people. Cryptocurrency, in fact, represents more economic prosperity by bringing about greater efficiencies, the removal of middlemen, by creating new use cases that were previously just simply not possible. Less wealth inequality, arguably because of the way the current monetary system works and money flows. I won't go into depth about that. And cryptocurrency also represents a new form of transparency, of absolute transparency, if you so choose. And this can be very useful for organizations, foundations, charities, governments. If they start operating on a blockchain, we will have complete transparency over their actions. At the same time, a cryptocurrency also allows for privacy. Now, some might see this as a contradiction, but it's not. What a cryptocurrency does is it provides people with the option to be private or to be transparent. And that is up to the user. And it's up to, people whether they want to sign up to an organization that enforces this type of transparency or not. Cryptocurrency is also highly accountable. You can read the code for yourself, or you can trust in the larger social mechanisms of hundreds of people reading that code. I don't feel we all need to dive into it in that way. And it's ridiculously secure. A cryptocurrency, a blockchain, is unbelievably difficult to destroy. It just refuses to die, essentially. As long as someone believes in it out there in the world, it will continue to live. It's not something that can be stopped. So something that I also like to say is that if you don't like cryptocurrency, that's okay. But it would be wise to at least deal with the reality that this is here. This technology is here, this technology works, this technology exists, whether you like it or not. Now, I went through these rather fast, and that's okay, because it allows me some time for questions. We are also not invested in BTC, actually, and I'd like to maybe just touch on that as well. That makes us contrarians within the cryptocurrency ecosystem, you could say. But the reason for that is because as a long-term fund invested in the fundamentals, we are going to stay true to that. And if our analysis tells us objectively that the emperor is not wearing any clothes, then we are not going to invest in that asset. And that's what we owe our investors as well. That's us staying true to our mission statement. And a lot of people might disagree with this, and I'm always happy to debate these points with people. It's always been a point of interest for me, let's say. Now, since I went through this so fast, I'm just going to open this up to questions. Any questions? Yeah?
Can you elaborate on the broken long-term security model of Bitcoin? Is it about segregated witness stuff?
No, it's less related to segregated witness, which is an upgrade that occurred a few years ago for any who might not be aware of this. It's actually related to certain changes within Bitcoin that occurred over the last few years. And with change here, I actually mean a refusal to increase particular limits within the blockchain. So specifically, there's a parameter in Bitcoin known as the block size limit. Now, the block size limit actually limits the amount of transactions that Bitcoin is able to do. So Bitcoin is currently limited to 7 transactions per second. And there is no plans in place to increase this by any significant amount. Over the next 5 years, certainly not. Now, the problem that creates is that how does Bitcoin pay for its security? Okay, Bitcoin pays for its security in 2 ways, and all cryptocurrencies, for that matter, pay for security in only 2 ways. That's through inflation and fees. Okay? Because something needs to pay that high cost. That high cost of security, of running the blockchain, needs to be reflected somewhere within the system. Okay? So, in the case of Bitcoin, the conscious decision was made to not increase the limit of the transactional capacity of that blockchain. What that means is that if everyone in the world wanted to do 1 transaction over Bitcoin, it would take more than a century. I don't see this as being particularly viable. However, to talk about your question more specifically, the long-term security model of Bitcoin, is that it's the question of where does the security come from. Now, in the case of Bitcoin, because it's limited to 7 transactions per second, the fees that a single transaction must have is extremely high. At current scale, within 5 years, we'll get a 75% reduction in inflation in Bitcoin. And if transaction fees do not reach $60 per transaction, then Bitcoin is starting to, and sustained $60 per transaction, then Bitcoin is going to have some very serious problems. I'm not sure who followed what happened to Ethereum Classic recently. Raise your hand if, okay, so that's more in the minority here. But Ethereum Classic is a smaller blockchain, and it was not too recently attacked. It was attacked for what is known as a 51% attack, okay? And the way a blockchain is secured is it relies on an honest majority, that the majority of participants are acting in their own self-interest, are acting, with consistency in regards to the rules of that blockchain. Now, when the security drops too low, so what I mean by that, there's not enough either inflation or fees, then the system actually becomes worth attacking. Okay? If you can make more money attacking the system that you would lose, I expect people to start attacking the system. And that's what I foresee happening to Bitcoin as well. Because I do not think that we're going to reach $60 transaction fees sustained per transaction, I think that the long-term security model of Bitcoin itself is in trouble. And that I'll go on to the next question. Yeah.
The Lightning Network enables cheap transactions that are way more accepted for everyone.
Yeah, sure. So the question was regarding the Lightning Network and how the Lightning Network provides a greater transaction capacity. Now, there's several problems with the Lightning Network, and this is certainly something I've spent a lot of time on as well. One major problem, as far as I see, is that in order to use the Lightning Network, you still need to do an on-chain transaction, right? If this on-chain transaction is expensive, that cost then transfers into the Lightning Network itself. So I don't think that the Lightning Network is cheap at all. If people are actually charging what it's costing them to run Lightning Network. So I don't recall the name, but the biggest Lightning node provider today, they've recently been putting out a lot of information, and they provide half of the liquidity to the Lightning Network. And they're running at a loss, right? So in order for them to run a profitable business, they need to charge higher fees. And Lightning can't work at scale if you don't have billions of dollars locked up in these liquidity pools. And there is a cost attached to locking up this much money. It's also a very inefficient way of creating liquidity, because in order for me to send, say, $1 of value, and I go across 4 hops on the Lightning Network, That means each hop needs to have the capacity of what I'm transacting. So for $1 transacted, I need $4 of liquidity locked up into the Lightning Network. And that comes along with a liquidity fee. That also comes along with I need to also pay for a watchtower. And there's several problems I have with this. One is that it's not cheap, and it's not easy, and it's not particularly secure, but maybe that's a bit beyond this talk today. It's also the user experience. I've been spending a bit of time recently working with Lightning, and it took me like a few hours just to go through all the steps to choose. So I can walk you through it. I have to buy Bitcoin, right? And that's what a normal blockchain is. You buy Bitcoin, you have Bitcoin, you can transact. I can essentially just pull out my phone, right? Anyone else's phone, and I can directly transfer value to another person without anyone in between, without requiring any bank, without requiring any institution. And it's easy. It's arguably easier than a lot of solutions today, like credit cards. Now, if I were to do a transaction using Lightning, I would have to first pay an on-chain fee to pay for my Bitcoin, to have my Bitcoin transferred. Then I need to do another transaction in order to fund a Lightning channel, which also costs me another fee. And then I have to wait an hour for that channel to be fully opened. Then I also have restrictions in that I can't do anything with less than $5, and I can't do anything more than $60 with the current state of the Lightning Network, which is very limited. So it's not suitable for coffees. It's also not suitable for large value, and it's expensive, and it's very difficult to use. So Lightning is being presented as a type of panacea for Bitcoin. That, hey, Lightning will solve all of Bitcoin's problems in this big hand wave. But when you really look at it, when you really look at this in depth, that's simply not the case. This technology does not make sense. It's also known as the liquidity problem. You know, we require billions to be locked up in the Lightning Network, disproportionate to the amount transacted in the Lightning Network. And to make matters even worse, this money needs to be locked up on what are known as hot wallets, exposed to the internet. I mean, you'd be out of your mind to lock up that much value in something that's exposed to the internet. So the whole idea, in my view, is rather fundamentally flawed. And that's just the liquidity problem. There's the routing problem. There's the liveness problems. There's a few what you'd call hard computer science problems that have not been solved. So no, I don't see Lightning as being a solution. And you don't get the advantages that you do from on-chain transaction, because you get that security, you get that transparency, you get that ease of use. You don't have those attributes when you use a off-chain solution, because you're literally going off the chain. Okay, next question.
The Austrian economist Sebastian declared hard money as money with hard assets as an asset with high stock-to-flow ratio. And some blog on Medium named Plan B showed a correlation between an increasing stock-to-flow ratio of Bitcoin and the Bitcoin price of the last about 9 years. Ever since it was really a little valuable. Do you see any value in that metric for determining the price of Bitcoin or other cryptocurrencies?
Could you define a stock flow model for me?
Stock is the amount of an asset that's present. So 190 tons, 190,000 metric tons of gold is the stock of gold, and the flow is the 3,000 tons a year, the yearly flow that gets, and that gives gold a stock-to-flow ratio of 62. Bitcoin currently has a stock-to-flow ratio of 33, and with the coming halving event of May 2020, it will rise to 56, close to the stock-to-flow ratio.
No, I definitely do think that model has value, actually. I will say that, because it is also looking at things like, liquidity. I mean, volume is important. And I would, usually say that is a valuable way to look at things. I wouldn't disagree, but I think technical analysis has its limits when you're dealing with something that is what I consider more of a toxic asset. Eventually, it's going to hit the fan, let's say. And that's fine. I mean, you can draw charts and say, hey, this is great. Something, actually, a metric that I find far more interesting, actually, is usage. So people actually using the blockchain, right? So I think Ethereum last week, they increased capacity by about 25%, and it's still completely full at about 35 transactions per second, compared to Bitcoin's 7 transactions per second. And even if that demand might be there for Bitcoin to use that on-chain capacity simply isn't there. So that's artificially constraining the usefulness of the system and artificially constraining the amount of on-chain transaction volume we can see, which I would actually consider a more important metric than liquidity on exchanges, which is more speculative in nature.
I was talking about exchanges at all. I was just comparing stock to flow ratio. And I agree with you there. As long as we see cryptocurrency as an exchange mechanism. If people don't pay their coffee with gold, they see gold as a store of value. And if you treat BTC as a store of value,
okay. Let me ask you this. So this is the way I see it. I say, yes, a cryptocurrency is a store of value. But a cryptocurrency is also supposed to be a currency. So now Bitcoin needs to compete as a store of value only. It's a purely speculative asset. And I don't consider that particularly competitive when you're competing with assets that can both be a currency and a store of value and have massive utility. It's that utility, it's that use as a currency that actually creates a better store of value. I don't think that a purely speculative asset is really a good store of value at all. No, at least gold has some usage in terms of industry and so forth. You know, I know most of gold value is obviously speculative.
I really don't like that part of the argument, because if that was any metric, iron would be a lot more expensive than it is today, because it has a lot more intrinsic value than gold.
No, but look at
The
this.
reason why gold is that valuable compared to iron is its scarcity.
So what has more value, currency or gold?
Currently,
Yeah.
gold.
No. What are you talking about? The market cap of currencies combined is massive. And if you combine the value of stocks, you combine the value of currency, you combine the value of gold, you put that all together, that's the value of a real cryptocurrency. And that's not what Bitcoin is able to achieve anymore. You know, it's much more than that. And to compete as a purely speculative asset against assets that have the same characteristics as a store of value, including far greater utility, yeah, that's something that we are more interested in investing in, and we can agree to disagree on this point. And but I really, the focus really needs to be investing in utility, investing in what works. You know, otherwise, you know, what are we even doing here? But just, you know, gambling with magic internet money. That's not what I signed up for 6 years ago. All right, next question.
I'm sorry, I just love this debate, but would you say that on-scale solution or increasing of the block size is the only solution for Bitcoin to thrive in the future, or do you see any other options to make it valuable in the future, or at least build on the security aspect of the blockchain, the Bitcoin blockchain?
Well, one of the best ways to increase the security of a blockchain is to increase its value. And in my view, one of the best ways to increase the value of a blockchain is to increase its utility. So by restricting the utility of the system for the sake of protecting its security, I feel is counterproductive. Because what a blockchain really needs is scale. It needs to have a geopolitical decentralization. That is a greater form of decentralization that we should aspire to, as opposed to creating this type of niche asset, which to me is a lot less interesting, obviously, as opposed to, you know, currency and governance for the world. All right, another question. Yeah.
I didn't understand what you said about this Bitcoin and the segregated business. They didn't change the block size, because from that time on we have Bitcoin Cash. I believe the block size is 8,000, and Bitcoin coin came with it a couple of months later.
So, okay, it's worth explaining this, actually. And this is actually a really cool aspect of cryptocurrency. And for the purpose of that, I can go back a few slides. And what we see here is this is what actually happens. And it's interesting that you mentioned this, and it's actually worth explaining this as well. In that a cryptocurrency is when there's a disagreement in a cryptocurrency, no one can force you to go along with a new rule set, right? Instead of, in a democracy, right, if 51% of the people vote to go one way, in most cases, the 49% are forced to go along with it. This is known as the tyranny of the majority. Now, cryptocurrency actually solves that problem. It has solved the age-old problem of the tyranny of the majority by allowing everyone the right to a passive succession. And that's what this is. If anyone changes the rules of Bitcoin, then another network will be created. Another currency will be created, right? Creating 2 Bitcoins in this case. And with these 2 Bitcoins, you have different groups of people that say, no, this is Bitcoin, and you have another side saying, no, this is Bitcoin, and you have one side saying, no, these are the best rules, and you have another side saying, no, these are the best rules. I mean, people see this as being quite an ugly thing, but I actually see it as being a good solution to these type of disagreements. People can go their own way. People can go their own way and decide for themselves what they want to be invested in. The brilliant thing about this mechanism as well is that when a blockchain splits, you still have a proportional share in both sides of a split. Okay, so an investor is protected. Right? And that's what's really great about this system is you're not forced to choose a side when this occurs. You can stay invested in both sides. You can rebalance. That's up to you. And price moves independently from that point onwards. Is that clear?
I think you said they will not change the block size. I believe they have changed the block size for another coin.
Oh, actually, I agree with that, actually. So, yeah, I should be more specific. BTC has not increased the block size and will not increase the block size. BCH has increased the block size. In my view, it's they're both Bitcoins, so these semantics can get a bit confusing, which is why it's useful talking about tickers. All right, another question, but I'm going to see if someone else has one first. Well, actually, anyone else?
Why is Bitcoin still #1 compared to the others psychologically in the world?
Well, you know, they have the first mover advantage. More people know about Bitcoin. Often when I tell people that I work in cryptocurrency, they go, what's cryptocurrency? And I have to say, well, you know, like Bitcoin. You know, but this is just a matter of time. And I do think that over time, as the market becomes more mature, as participants become more sophisticated and more informed, this will start to become more apparent. And I think the market will become more rational over time. So I think a lot of people still believe in the vision of Bitcoin, and that's okay. But I think they're wrong. I think they're wrong technologically and economically as well. So, you know, this is where history will prove me either wrong or right. But it wouldn't be the first time that a large dominant asset or business has lost its dominance to a newcomer. You know, just because Bitcoin was first does not mean it will remain the largest or remain the biggest cryptocurrency. I think that's important. Does that, yeah? Yeah. Absolutely, I would love to do that. Yeah, so the largest investment now in cyber capital is actually Ethereum. Yeah, and Ethereum is a very interesting case because we have a lot of on-chain activity. We have the vast majority of applications being built over Ethereum. We have the vast majority of institutional adoption. We have most businesses operating, most applications being built on it, and also really at the cutting edge of this technology. So really Ethereum, if we look at it objectively, is leading in all metrics except for market capitalization and brand. Now, I don't think that market capitalization and brand is enough to keep the #1 position. So yes, I'll stand here quite boldly and say I expect Bitcoin to lose its dominance over time. Sorry? The right miner? I hope so, yes. Okay, another question. Anyone? All right, here you go.
In respect to immutability, what are your thoughts on the rollback of Ethereum
So the nuance here is quite important. Technically, the Ethereum blockchain never rolled back. I know people like to say that, but in reality, I don't even think it's possible to have rolled back the Ethereum blockchain. And I feel this is a bit of misinformation, let's say, that we often see floating around. But what actually happened, and this is referring to the DAO hard fork, we're getting very stuck in the woods here. We have some crypto experts asking me questions, so I hope it's not going too much above people's heads. But no, what actually happened there is there was a bug in a smart contract. And what they did is they changed the smart contract itself. They did not roll back the blockchain. There was no reversal of blocks. There was nothing like that. And I don't believe it's possible. So it's a bit of an unfair comparison, let's say, because Ethereum rolled back another layer of itself, which Bitcoin does not even possess. And I was a supporter of the hard fork at the time. I like to use the analogy of stopping a bank robbery in process. And I thought that was very okay under this scenario. And I also think that a blockchain's consensus algorithms is its own authority. So if the blockchain, majority of people in that blockchain want to go this way, then that's legitimate. In the same sense that the people that split off, that was legitimate as well. You know, people can go their own way and people can live under the rules that they want. It's not, you know, geographically bound how, you know, governments operate in this case, which is another fascinating aspect. Yeah. Litecoin? Okay. Well, I think the joke is Litecoin is essentially a copy of Bitcoin with a few parameters times 4. That's it. I have to admit, I'm not particularly impressed from a fundamental analysis perspective. There's no new technology there. They're also not committed to scaling that chain as well. So it's not particularly interesting for me. There has been no major developments over Litecoin for, well, since it was started, I suppose. So yeah, I mean, we can get more into that. So some of the network layers we're invested in are things like, not investment advice, by the way. So we're invested in something like Chainlink, which is a decentralized Oracle system. We're invested in MakerDAO, which is a fantastic project, creating a decentralized stablecoin. I mentioned this earlier as a kind of a textbook example of good token economics. We're invested in some other protocol layers as well, obviously. Things like Tezos, Dash, Bitcoin Cash even. But Ethereum is definitely our largest investment now. We have over 30 different cryptocurrencies in the fund, but there's definitely a long tail there where some of the larger, more significant protocol layers are more dominant in terms of that balance. Yeah. Yeah. So DAGs are interesting. The term DAG is a bit confusing because I think a blockchain is technically also a DAG. So I prefer to use the term tangle here actually. IOTA, I'm not particularly impressed by. They haven't managed to get rid of the central coordinator yet, and I don't see any clear path to how they are going to do that. I also was not particularly a fan of rolling their own crypto. I'm not sure if you're familiar with the story, but yeah, so that just doesn't reflect well and does reflect on some red flags. As far as tangles go, I think I'm not particularly bullish on it, but one that seems to be functioning okay is Nano. You might have heard of that. It basically combines Tangle with a delegated proof-of-stake system, so they solve the central coordinator problem that way somewhat. Yeah, but I'm not particularly bullish on tangles. They tend to end up as a bit of a mess in a tangle, you could say, yeah. All right, back there.
Why would we put our investment inside of it?
Oh, that's a good question. Well, for one, we have expertise. We have a team of people that research this full-time across different disciplines. So the idea here is that we'll be able to do a better job than someone who still has a day job, let's say. It certainly is a very intense space to be a part of. Also, we're very secure in the way we have set things up. We have, important strategic partners that check our solvency on a weekly basis. As a matter of fact, IQEQ, who's our fund administrator, actually has our public addresses and also APIs into our exchanges. So when we report the price on our website, that's not coming from us, it's actually coming from our fund administrator. So you don't even need to trust us when it comes to us reporting on the price of the fund. Because we have this set up in such a way. We're also registered with the AFM under the IFMD light regime, yeah. So this creates a lot of legitimacy. We've gone through a lot of effort to be compliant in all of the ways that you can imagine, from source of income to KYCing the exchanges to creating very elaborate cryptographic ceremonies for our security as well. So just to touch on that, we actually use a sharded key setup. So we're actually able to split keys into multiple parts, which we then able to create trustlessly. That's important within a cryptographic ceremony. And we're then able to distribute those shards to different parties who then hold these words on a piece of paper in different bank vaults held by different parties. And this is obviously, it's not easy to hack multiple underground bank vaults and with pieces of paper with words written on them. It's ironic somewhat that that's the most secure way to store cryptocurrencies, with a pen and paper, but that's where we are. Yeah. So it's really, it's also, the technology is also in its infancy in many ways, and it can be challenging to secure your own wealth this way. It's easy to make a mistake. And we have processes like a 4i principle, and, we have a cordoned off secure room. Takes me about 30 minutes before I can even log into an exchange. It's very annoying, but that's also what provides a lot of that security as well. Yeah. All right. Do you want to maybe say some words here, Gert, regarding security, actually?
Well, in fact, we rounded off the circle. I started with being secure in your processes, being secure in how we manage the fund from an operational part of view. Then we came to be secure about your investment process. Justin elaborated on that a lot, and by answering the questions, I think you have the feeling he was pretty secure about his answers as well. That's what it means in nowadays investing in cryptocurrencies. It's not only being the whiz kid, not having a nice idea or following a Bitcoin without knowing what's behind it. It's also knowing what is your structure. What is the structure of your investment company? What is the structure of your fund? 4i principle, external parties, and be secure about all processes you have. So in that case, yes, we rounded off this whole presentation, and we made the circle round, and we thank you very much for your attendance. And we thank you very, very much for hearing us. And we all hope to see you on our website, downloading our prospectus, and maybe see you as investors in our fund.